Good day to one and all. This is Dr. Sivaraman of IKnowIndices.com. Hope I am audible. Let me display the PowerPoint presentation. Hope the audibility is fine. Yeah, okay. Hi Mud, how are you? After a long time. Now let me display the slide. Tracking the forex market together part 1 on November 1st between 9 and 9:45 GMT. We'll be tracking the market using the live market code page as a simple tool. So let me give the link for the live market code page and also focus the camera over that of the live market code page. Now you should be able to see the live market code page. Euro is trading around 1.3709, 1.3711. So just below the psychological level 1.37. The lowest at 1.3675, the high was 1.3870, 148 pips they had already dropped. And in the case of GBP, it is below that of 1.60, and during that of the Japanese session, I was giving the webinar, and at the time it was above that of 1.60, now it has come below because of the selling pressure and the players are making further drop, and it is currently trading around 1.597579, 1.5964 is the low, 1.6093 is the high, 108 pips negative net change is seen. So Euro has made more drop when compared to that of GBP, and you know that GBP data is expected to be released by 9:30 GMT. There could be some volatile moves, and then for the slide, in the case of GBP. USD Yen 7809, 7812 after a much awaited intervention. When they had taken it to 75, the story of intervention came in and it has come to 78 area, and further gain is expected in the case of USD Yen after making some contrarian moves. Now you come across Euro and GBP and USD Yen are showing negative net changes, indicating that they are just pushing down the Yen crosses like Euro Yen and GBP Yen with a negative net change. Afterwards, they are expected to gain back the levels again by gaining more levels in the case of USD Yen, giving another story of intervention. Now you see that it's CHF after the data release, they quickly made the gains and it has gained about 121 pips positive net change when Euro has made about 144 pips negative net change. And during that of the Asian session webinar, I was explaining that they had just made the lesser gain in the case of USD CHF when Euro was dropping during that of the Japanese session in order to push down Euro CHF a little bit. And from there they gained quickly from 2142 to 2196, about 50 pips gain. They have done it, and that is because of the quick gain in the case of USD CHF, even though Euro has made the drop. So this is how yesterday they just made the drop in the case of Euro and rise GBP, thereby Euro GBP made the drop. Now it has come to 85 area, 85, 84, 89, 85, 87 are the current levels in the case of Euro GBP. So for the month beginning, they are making the contrarian moves in order to handle the crosses. And contrarian move, you know that definition, that some making USD gaining moves at another pairs will be, and that is referred as a contrarian move. With regard to the commodity pairs, you see the quick rise in the case of USD CAD. From morning it was trading below that of parity and a little bit above that of the parity. 1.0008 was the initial high. From there, substantially they had gone more than 100 pips. 1.0102, 1.0106 are the current levels. Similarly, in the case of Australian dollar, I was making an explanation and the remark during that of the Asian session that on Friday they gained about 200 pips, 200 plus pips in the case of Australian dollar. Such quick gains are mainly to offload the positions and induce all the short covering, later on make all the way down move, and they are already done 166 pips drop. And morning, many were thinking that 1.0480 could be well defended, even though the interest rate was cut by basic point of 0.25, and I was explaining that the players are expected to pretend as if they are respecting the technical analysis and try to make the moves up to that of the support level and just hover around, make small gains, and induce the traders to take the long position, afterwards make the drop. And I was also explaining that they just continue to cut the lows in the case of Euro and GBP during the Japanese session, indicated that they wanted to do the intentional move. So an intentional move normally prevails for about 2 sessions on the start of the 3rd session. You can see that is what happening. They continue to cut the lows every 30 minutes to 1 hour and not making much of a pullback. And thereby, any level you buy, you might be stopped out. So that is a scenario they bring in order to induce all the long holders to liquidate. Last Friday, they just took it up to 1.42 with all the euphoric conditions, and I was telling you that month end, they are known to make such volatile moves as if they are just turned around and showing a different phase, and later on you find everything has come to the same condition, that now they are focusing more on Euro crisis and things like that, the understanding, etc. So the drop now, they might be calling it as a weakness of Euro rather than strengthening of the USD. This is how you find that the different occasions, different interpretations are given in the market, and ultimately to see that the traders continue to believe such things and try to lose money as if it is next to impossible to trade in the market. So let us analyze how exactly we can read such intentions and try to trade in the market. Okay. I'll focus back over that of the PowerPoint presentation. Before that, sorry. Let me just briefly show you the initial lows and the highs set for today, so that from there we'll be able to take it up. So morning I showed this particular slide, initial lows and the highs set for the day around 3:30 GMT, and that is used as a reference level for the players to make the moves in the market. Euro formed the low 1.3814. From there they already corrected about 100 pips, and once they cut the low and stay below there for more than 30 minutes, and we understand they could drop for 2 hours, and after 2 hours, if they continue to cut that low, then we identify that it is an intentional move. Then the drop will be there for 2 sessions and the start of the 3rd session. So now our reading has become correct, and they are really making the slide of that nature. In the case of JBP, 1.6054 is the low, and that also they have breached and formed for the lower level, 1.5964. And in the case of CHF, I was telling you 0.8794 they showed. Now they have come to 0.89 area. Straight gain, they have made it. And on Friday, they came down to 85 area as if USD CHF is going to trace back to that of 0.8283 area. They pretended that way and started gaining the levels quickly. In the case of yen, much awaited intervention story came in on the last day of the month. And the previous month, we had the story in the case of USD CHF. So they are all pre-planned. And once the traders cut all the long positions, they show the story or give the story of intervention and gain substantially the levels. Similarly, in the case of USDN, they brought it down to 75 area. Then the intervention story came in, and on the same month end, just in a matter of 2 days, on 28th they showed 75, and on 31st they showed 79. So that is how you find that either way they hit the stops and earn substantially, induce the long to liquidate, and reduce the shorts to do the short covering, all earning process. Then in the case of Australian dollar, 1.0499 was the low, and they breached substantially and formed 1.0328 as the low now, and 157 pips they had dropped as the net change. You can see it in the live market quote page. And similarly, Canadian dollar, 1.0008 was the initial high. From there, they had taken it up to 1.0128. And this is how they make massive moves during the last week of the month and the first week of the month. And you come across the monthly trend reversal moves happening during that time. So small traders, it's better to avoid taking positions during that time, because when they make such big moves, your equity may not allow you to hold such positions without a stop. So let me go back to the other slide. Now, another important aspect in order to understand the market, namely the market reading. You know that the daylight saving system is off on 30th of October. From 30th of October, you come across the normal timings in the case of Europe, and from 6th of November, US will also adapt the normal standard time. So you find that the market timings are being changed. These are all the timings followed by that of the players, depending upon the closing and the opening of the banks in respective countries. So, but this nobody will be giving to you, and this is how they make use of the time and try to make the stop-ons, etc. So you need to understand the timings in order to track the market. That is why I displayed it. So from 31st, from yesterday till 4th of November, till end of this week, you come across the market timings. There is a shift in that of the European trading session. So 0030 to 7:30 GMT is the Japanese session, and 7:30 to 8 is the gap time. Then European session starts by 8 GMT and ends by 13 GMT. Still, US will be having the daylight savings time till 4th. So you'll be having the normal US session from 13:30 to 20:30. 13 to 13:30 will be the gap time. So today, after the start of the US session, 14 GMT, I'll be taking the second part of the webinar. At that time, I'll explain to you how exactly the basic trade can be initiated after watching the market 30 minutes from the start of the session. After 7th of November till mid-March, you will come across the standard time. So Japanese session will be up to 7:30, then 8 to 14 will be the European session, and US session gap time will be from 14 to 14:30 GMT, and US session will be from 14:30 to 21:30 GMT. Then gap time starts from that of 21:30 to, and it prevails till next day, 0030 GMT. And as I have been explaining for many years, that all the gap time moves are false moves, and you can understand that the players use specific type of orders to hit the stops on either side. If they make a downward move quickly during that other gap time, understand during the session they wanted to rise. So it is something like a bouncing ball. They just hit the stops of the long holders by making a quick drop and then continue to rise with the least selling pressure. Similarly, they make an upward stop and hit the stops of the short sellers and then make the continuing downward move. So gap time moves are false move. That is why I want people to focus on the gap time to understand this. Now the factors to be considered while doing the market reading. So we track the market using the GMT time. In the live market code page link what I have given, you come across the GMT time. That becomes a ready reckoner for you. You need not calculate the GMT time. And from that of your local time, you can simply follow the GMT time shown in that of the live market code page, and that will be helpful for you to understand the sessions and the gap times. And once you make a mark of the sessions, and each session is further subdivided into 1 hour and 30 minutes of session start time and 1 hour and 30 minutes of late session, and the balance will be the mid session. So during that of the start of the session and the end of the session or late session, they are very active in handling the majors. The 4 majors, Euro, GBP, USD CHF and the USD Yen, and also the commodity pairs, USD CAD and Australian dollar. And during the mid-session, they handle all the European crosses and also that of the Yen crosses. So that is how they handle the market, because simultaneously they cannot handle all the markets. They have to hold one currency and rise another currency or drop another currency. Thereby they'll be able to bring in the moves in the respective crosses. Yesterday they made a very typical move, that holding Euro, they just quickly gained the level during the US session in the case of GBP in order to drop Euro GBP cross. So this is how they make the moves, and currently also you can come across they are making a contrarian move. Euro is showing negative net change, GBP is showing negative net change, and also USD-Yen is showing negative net change. This is to mainly drop yen crosses. So this is how they make the moves in order to handle the crosses that you can easily understand by looking into the actual price of the market. Not even the tick chart, simply watch the price in the live market code page. You'll be able to really understand how they are making such moves from the other market. Then make a note of the high and the low net change and compare it to that of the market. I showed you the initial lows and the highs set around 3:30 GMT, and from there you just make a comparison to that of the current levels. Then you will be able to understand that whether they are dropped to the market or rise to the market from the start of the day. And it is a 24 hours market, so they act on the 24 hours time frame on a daily basis from Monday to Friday. Then identify the currency which has made more than 40 to 50 pips, and only in such currencies you try to take positions. You will be able to make swing trade in them. And if a currency is making less than 40 to 50 pips spread between the high and the low, they may not give any of the trading opportunity. Probably early part of last week you would have noticed that USD-Yen was making about 10 to 15 pips spread between the high and the low, and they have been holding it simply without giving any opportunity for the long holders or the short sellers to book profit or even stop out. So that sort of situations will come. So when the spread between the high and the low in the live market code page, we see if it is more than 50 pips, then try to initiate a buy near that of the low when the low has not been breached for more than 30 minutes from the start of the session, or take a sell when the high has not been breached for 30 minutes from the start of the session when the market is near that of the high. So this way you are not biased, you are not bullish or bearish. You only try to look for swing trade opportunities. After the drop, we don't enter sell. After the rise, we don't enter long. And they are all emotional trades, and the players want the traders to make such breakout trades and give profit for few occasions and trap them vulnerably. So we wanted to do safe trades. We know that everybody talks about the risk in the market, but very few talk about how to avoid the risk. So obviously we need to understand that when you listen to that of the emotions, our decisions will be wrong. All emotional decisions are wrong. It has been proved beyond doubt. So don't be under the grip of emotions, and calmly and use your common sense and try to trade. You will be able to successfully earn money from that of the market. So when it is available cheap and when we feel like buying, when it is expensive, we feel like selling. That is a normal human feeling. But in the market, in the name of breakout trade, we are being advised to buy during the quick rise and trying to enter into the running bus and see that we entered when the bus has already reached the destination, so no more travel from there, and start reversing and we get stop out. So avoid such emotional trades, and when the opportunity is lost, when you are not participated in the market move, it doesn't mean that you have lost the money. You have only lost that opportunity, but market continues to give opportunities. So every session you come across up and down moves, and you can do either buy and sell trade or a sell and buy trade. But ultimately, after buy, the market should rise. After the sell, the market should drop. That is what we envisage. So that we need to be very, very clear in our understanding. Then with regard to the entry, I explained to you the basic trading will be just sell near that of the high if the high market is near that of the high and not breach the high. So in the case of euro, the high is 1.3870. Currently it is trading around 3726. So obviously it is not expected to go near that of the high immediately. Then if it is near that of the low, we can take a buy, but the low was 1.3814. It has already gone down below that of the low. So what sort of trading ideas we can develop? I'll explain with the help of the next slide. Whenever such breakout happens above that of the high or below that of the low. So in a basic trading strategy, we sell near that of the high and buy near that of the high, low without any bullish or a bearish feel. We aim to only book profit in such small swing trades. Then exit. So when you are taking a sell position near that of the high set for the day, try to close it near that of the low, or when you are taking a buy near that of the low, try to close it near that of the high. That will be the basic idea, because they are expected to make such moves in the market from session to session. Then, when you are taking a sell position near the high, when they come closer to the low and not breach the low for 30 minutes, you can close it. But in case if they breach the low and stay below, then maximize the profit when they are making the moves further down. For that, we need to understand what are the type of moves they are making in the market, so that it is not that you try to identify where to keep the stops and things like that. How to maximize the profit is also a skill. So we have to definitely focus on that. First of all, before making the profit from that of the trade, you have to limit the risk. So how exactly you can limit the risk? Once you are taking a sell or a buy, keep 30 pips. That will be an optimal stop, and 30 pips of stop or the hedging order. And once the position makes about 20-25 pips profit, keep stop at entry and remove the hedging order of the other stop. Thereby, if the market hit your stop, you don't lose anything. So the first step in trading is reduce the risk to nil or prevent the risk, because everybody is talking about the risk and the risk management and things like that. But ultimately, you trader can read all such risk managements, etc. But unless and otherwise you put it into practice, you are not going to avoid the risk. So always keep in mind, as soon as the position is taken, you have to keep the hedging order from 30 pips away from that of the entry. And once the position makes profit, keep stop at entry. So thereby you are avoiding the risk. Some may say that, okay, if I keep the stop, they hit my stop and go away. It doesn't matter. If they hit your stop, they may give a better entry level. So always keep that in mind. The market continues to give plenty of opportunities. So if you find that 1.38 is a good entry level, after about 1 hour, they may show 1.37 as an entry level. So that is how the market behaves. So we need to understand, and no position is precious. And they are all positions, they are to be closed in the market. You cannot carry it along with you. So they are all nothing but the trading positions, and you have to close it in the market. And a leverage trading, if it is a delivery-based trading, then without any leverage, then probably you can take the delivery and be possessive of Euro or GBP and things like that. But in the market, these positions, there is no point in becoming possessive. You have to simply close it, whether you like it or not, with a profit or with a loss. So don't have any bias and don't have any sentimental attachment to any currency, and don't immediately say that Euro is going to dogs or USD is going to dogs. And when you express yourself that way, you become emotional without your understanding, without reading your own mind. And once emotion grips your mental decision-making process, it gives wrong guidance. That's what you will come across invariably. And once the market drops, after the complete drop, some people just liquidate the long and turn short and find that at the lowest level they are shorted the market, because they think that Euro could go to 1.27 and short it around 1.37 and find that it goes to 1.42. This is how the market makes such moves, and immediately people say we will not be able to read the market, and market is unpredictable and nobody can predict the market, etc. But if you try to understand the market moves, then you will be in a position to predict without anybody's help. So when entry and exit can be fine-tuned, like by placing the limit orders, keep a sell limit order near that of the high or a buy limit order near that of the low. It's very easy for you to enter into the market. At any given time, we take only risk of 30 pips by keeping a hedging order of 30 pips. So that When the market moves against, we only lock 30 pips or keep stop, then we lose only 30 pips. It is predetermined. And that way, if you try to do it, you will be able to consistently earn from that other market, and also you will not try to violate the rules you have formed for yourself, like not to move the stop away from that of the market, and when the market shows profit, quickly grab it. Normally the traders have got the tendency when that loss mounts, when the loss increases, they continue to hold it and try to simply do that averaging without understanding they are doing over trading. But when the position shows profit, because of the previous experience, in 10-15 pips profit is shown, immediately they close the position and repent later on when they rise another 100 pips away from that. So when you are under the grip of emotions, it is next to impossible to earn from that other market. Keep always in mind that market has to be approached with a calm mindset. Then, in case if they breach the initial low or the initial high, then what we identify out of that? First of all, we have to identify the type of moves what they are trying to do it. And it is a very simple concept. So, the type of moves are determined based on the time taken for such moves. A stop point is a move, they cut the low, initial low, and go below for about 20-30 pips and come above that of the initial low in less than 30 minutes. Then it is a downward stop point to make an upward move. Or similarly, above that of the high, just move about 20-30 pips and then drop and come below that of the initial high. So if you refer to that of the initial lows and the highs throughout the day, you will be able to easily identify the type of moves. So stop point is the one which is above that of the initial high or below that of the initial low and reverse the market. A false move is the one they make it during that of the gap time. They go up to that of the high without breaching the high, come down. Or sometimes they go up to that of the low without breaching the low, come up. And this particular false move will be followed by extended move. They come closer to that of the low without breaching the low, come and cut the high and stay above the high for 30 minutes and start gaining the levels. Even though the European data might be negative, they will be rising euro or GBP. And that is how they make the move. That extended move is always a quick move. So above that of the high, they could extend the rise, and this will last for about 2 hours. Stop and false moves remain only for 30 minutes, whereas extended move is for 2 hours. In that 2 hours, every 30 minutes, they will cut high and go above, cut the high and go above quickly by circular trades. Thereby, the traders really develop the fear when the market moves in such a quick fashion. Immediately they think that it is going to heaven, and straight away they will say, okay, no, euro can go to 1.50 when it is around 1.37. Immediately they come to that particular conclusion because they look into that of the indefinite channel. When you continue to draw it, it can go even to infinity. And that is a flow use for us. So, but they just gain for about 30 minutes, and every 30 minutes cut the high and go above. After the last 30 minutes, they stop cutting. After gaining the levels, by the time you would have noticed that they would have just gained about 150 pips to 200 pips in the net change level. Afterwards, they hold high on Friday. You know that then they were holding around 1.42 and they have been selling after quick rise. And people were bullish at that time, but the players were selling. Now we realize that they have been selling on Friday and now they are trying to buy against that. And that is the intentional move. After the extended move, they make the intentional move. The intentional move is the one which prevails for about 2 sessions and the start of the 3rd session. Extended move is only for 2 hours. In that you come across a very quick rise or a very quick drop and the reverse the next day. That will be the intent. Always after that of the extended move, the intentional move will follow. There is no change as far as the players are concerned. Then today you come across the intentional move. From that of the Japanese session, they started making the drop. European session, whatever the data, they are making the drop. And after the US session, they are expected to make a drop during session start, first 1.5 hours, and accumulating the buy positions when the traders turn bearish and start gaining the levels. Tomorrow open high and go up. Then everybody forget about today's data, tomorrow's data, we'll talk euro is bullish. Today euro is bearish. So alternate day, they change the market sentiments, and it is next to impossible for human beings to change the sentiments so quickly. You know that we become sorrowful sometimes, we cry and things like that. We find it extremely difficult to change our sentiment or the mood, excepting if we have the histrionic talent of changing our facial expressions like the actors. So you find another one, namely extended stop, and this they do it during that of the trend reversal time, the last week of the month and the first week of the month. Quickly gain the level 150, 200 pips and drop in a matter of about 1 or 2 hours or 3 hours within the day and start continuing the drop. So that is extended stop, and upward to hit all the level stop. What they had done on Friday in the case of Australian dollar was an extended upward stop, and so that nobody can hold any short in the case of Australian dollar. Afterwards, the players alone are destined or they are privileged to hold the short positions when the traders have done the short covering. Then when they continue to drop, the long holders just liquidate, and those who have gone short at a higher level repent. Oh God, I could have held the sell position, I'd have made about 200, 300 pips profit. But because of over trading, because of margin fear, the person would have cut the position. So this sort of moves only induce the traders to avoid keeping stop. You have to understand the trader's mind that it can think only that way, obviously, because when we frequently find that the stop is being hit and our call was correct, immediately you avoid keeping stop. But you have to control it. Instead, you have to keep hedging in order to limit the risk. Otherwise, take very less positions and spread the risk by taking every 100 pips another position so that you are not threatened of my call. So when they make that extended move on the upside or the downside, wait for 2 hours to confirm whether it is an extended move. But if you become practiced, you will be able to identify. Like during that of the Asian session, I was telling you that they cut the low and stayed below that of the low, and they made on Friday and Monday the extended move. Obviously, they are expected to make that of the intentional move today. And they were holding yesterday the lows, the levels, and further made the drop, which indicated that they wanted to make an intentional drop today. So that out of experience, you will be able to see from that of the first move itself what sort of move they are trying to do it. That is what I am posting it in that of the blog. So you can also develop that particular skill rather than asking me frequently every half an hour or 1 hour what is expected of euro, what is expected of GBP, etc. It is not difficult. It is like driving a car, and once you learned how to drive the car, you don't keep an instructor all along with you whenever you are making a drive. Probably for about a few months, you might be keeping an instructor along with you. Afterwards, you will be driving on your own. After about 2-3 years, you will find you will be talking to a neighbor who is sitting adjacent to you in the car, and still you will have the road sense to continue traveling without any strain of driving. That should be the scenario once you become an experienced person. For that, the most important thing is understand the type of moves rather than focusing on the levels. See, when they showed 1.37 earlier last week, many were thinking that it is a sell level. But now they had dropped it. Once you, from that of 1.42, you identify it as a buy level. So the market perception changes from time to time. So don't give importance to that of the level. Identify the move. When you focus on the levels, you fail to identify the moves. When you try to identify the moves, the levels become immaterial. Whether you buy euro at 1.40 and book profit at 1.4030, or you sell euro at 1.3750 and book profit at 1.3700, it is immaterial. Ultimately, you earn 30 pips profit or 40 pips profit. So focus on that particular profit rather than focusing on the levels. 99% of the traders focus on the levels because of the chart reading practice, and they find it extremely difficult to come out of that, and Because of that, whenever they see a quick drop, they don't feel like buying. They find that the next support is at the bottommost level, probably at the deep down in the earth. Then later on they realize that, okay, I could have taken a buy at that level, a small buy at that level. So repenting is of no use. You have to participate in the market, only then you can earn. So always keep in mind the quick moves or false moves in the market. And then you will be able to really understand the slow moves or the intentional moves, the quick moves or the extended moves, or the spikes or the extended moves. And the spikes are made mainly to gain the levels, and the intentional moves are done mainly to slowly gain the levels or slowly drop the levels, and in the slow drop they try to buy. So you might be thinking that are they buying euro or are they selling euro? What they do is they just sell about 500 lots and buy about 1,000 lots. Sell 500 lots and drop the market and buy 1,000 lots. That's how they just do the swing trades on the bottom. If they want to buy about 5 million lots in one stretch, nobody will sell it to them. So they have to drop the market so that the people become frightened and afraid of the margin fear, and they wanted to just get rid of with a bearable loss and just sell it to them. Only after the drop people will sell to them. If they hold it at the higher level and ask the people who have taken the long at the lower level to sell, nobody will sell. Everybody will say, let it go further up, then I will sell. But they may not rise and drop afterwards. Then later on, next time when they rise, quickly they book profit. Later on the market continues to move. That is human psychology. So don't go with your past experience. Don't go with a reference of an earlier trade. Then it is very difficult to come out of the emotional grip. Now, I wanted to explain something about the advantages of hedging, because in European trading platform, the hedging facility is available. Hedging is used instead of stop. Simply you can use it as a stop, and if it is hedged, you have got the time. You will have a buy position as well as sell position. You can just review the market, and you find that, okay, no more holding that position, simply close the original position with the hedging with 30 pips accepted loss. Instead of keeping a stop, if you keep the stop, they hit the stop and go up, then you don't have a position to participate in the market. Whereas if you are hedged, and if the hedging, if you watch and it is not making profit for 30 minutes, understand that during stop and they have just hedged you, and just close the hedging and keep another hedging order 30 pips above. When they make the move in your favor, start keeping stop at entry in your buy position or sell position, and try to trail the stop. Always trail the stop in profit-making position and not in loss-making position. Try to trail the stop in profit-making position. Keep a limit. If you are taking a buy near the low, keep a limit near that of the high and trail the stop. The market can hit either your trailing stop a distance of 30 pips or the limit, so that your assured profit is taken. Once the position is closed, you have got another opportunity to take position. Don't accumulate simply positions every 20-30 pips moves, and then that will lead to over trading. So always take one position as small trader, and if your equity is less than $30,000, try to take only one mini lot at a given time and try to use the hedging to handle it and try to close that particular position. Then think of another mini lot. You will not have any margin fear, and consistently you will be able to see the profit booking opportunity. And if you continue to average it, then you will find the market can move against you 200 pips. By the time you would have accumulated 4 or 5 standard lots, then all the 5 positions will be withdrawing that usable margin from your equity. Then you will get 50% of the usable margin is eroded just like that. And it is not market fault. It is your fault. You have overtraded. So as beginner, people are bound to do overtrading. It is something like a person who has learned driving. You will always go in for a rash driving. Later on you will realize that controlling the speed is the skill of driving. It is not simply allowing the car to go in hectic speed and you just enjoy it and not in a position to apply the brake appropriately. Then hedging can be used for either way trading. So if they just hedge you and go below, you can keep stop at entry in the hedging. Let them go against you any level and still you are blocked only 30 pips. And when they start coming in your way, see, you know that you had, suppose last week you had taken 1.38, a sell position in the case of euro and just hedged at 1.3830, market went up to 1.42, you are not bothered. When they come to 1.3830 and just close your hedging, then the sell position makes profit, keep stop at entry and try to continue on the downside. So it gives enormous opportunity for you to continue participating in the market. Or you can do either way trading. When they go up, book profit in the buy side. When they come down, book profit in the sell side. For that, you need to take only one position. Then your doing will be very good. If you take about too many positions, you find extremely stressful to handle the hedging. Then you expect somebody's help in that. Otherwise, say that hedging is useless. So if I do not know how to drive a car and say those who are driving the cars are fools, that means I'm a fool. Then hedging can be used to reverse the trade when the other way going is good. Suppose I got a buy position and a sell position. And the sell position, buy I taken and the market drops, sell is there is a hedge and market continues to drop. Then I find that it might take about 4-5 days for it to reverse it. I simply close the buy position with 70 pips loss. In that, 40 pips profit will be seen in my sell position. And when they drop another 30 pips, I'll have a break even. When they drop further down, I'll be in net profit. Then hedging is used to hold the position and continue trading when time permits. So this is another important aspect. Whenever you have to attend to an important event, you need not say that, sorry, I'll not be able to come, I am in trading. You need not say that. Simply hedge the position in the market. If you know how to handle the hedging, then later on attend to your work. So no compromise on lifestyle and come back and continue trading. So these are all the opportunities. I am not having much time. So let me just continue it during the second part of the webinar. So in this session, Euro and GBP are expected to swing, and so that's what you are seeing. So now actually, I don't find any good trading opportunities in the market. That's why I've taken more time explaining the concept rather than simply taking the position and say that I have booked 20 pips profit or 30 pips profit, because it is a falling market. In a falling market, after the drop, it is not sensible to sell. During the pullback, we can take, but now the webinar is between 9 and 9:45 GMT, so they are not going to do the pullback in Euro and GBP now. During the late sessions, they couldn't make a pullback. At that time, we can take a sell. So I'm extremely sorry that I'm not recommending any of the trades today, because already they had done the maximum drop of 150 pips in the case of Euro. And in the case of GBP, after the data, 9:30 data, they had dropped about 154 pips, 1.5929. So you can understand that the data release of a lesser importance, only the trigger is being used by 9:30. Already they have been making the drop. In the case of GBP, people might think that fundamentals is going to play a role and try to enter after that of the market swing, but they continue to drop GBP. So that is how they make the moves. And you know that yesterday they have been rising GBP, which indicated for today's data they wanted to drop. They are all pre-planned. And if you understand well, then you will be able to just laugh at them and try to earn profit along with them. USD CHF, they have just made an aggressive rise and they are making a small dip. And now about 111 pips negative net, positive net change is seen. Any dip, you can just make a buy during that of the late session. Now it is mid-session. They are simply handling the crosses, making small swings. We can earn about 10 to 15 pips. USDN, they are just gained and holding as usual around 78 now. Probably they will gain the momentum during that of the US session, because now currently it is showing 2 pips negative net change. And they are doing contrarian move. Whenever they are making contrarian move, don't enter into that of the majors. because the majors may not make any big moves. When they make contrarian move, understand they are handling the crosses. In such crosses, you can take positions, but not in majors. Because if you want to book profit in the same session or within a few hours, and that should be the objective for most of the traders. Nobody, unless and otherwise you are possessive of positions, nobody wanted to hold the position for a prolonged period. Now we can see that Australian dollar is melting down like anything, and you can understand how they gained about 200 plus pips on Friday just to make a drop. Now, so suddenly they change the sentiments, and people find it difficult to change the sentiment. So that is the mindset. See, we have a limitation. You know, in cinematography, when the stills are moved 16 frames and more per second, you will not be able to see the still photograph. Instead, we see only a motion picture. It is something like that, similar to that. When the sentiment is created, it is extremely difficult to change the sentiment in a matter of about 30 minutes or 1 hour and things like that. But the players have got the skill set. Only if they have the skill set, they can become players of that nature. And they quickly change the market sentiments by making a very opposite move, simply using some trigger factor as an excuse. So we should be prepared for it. So always expect the unexpected in the market. Then nothing will give you surprise in the market. So at the moment, if you look into the cross also, any possibility, because time is up, yen also there just breeze. So let me just make any positions. I'll try to take the positions during the US session. I'm extremely sorry about it. And I'll come again by 14 GMT and give you the trading ideas during that of the US session. So I have taken much of the time explaining the basic trading strategy, explain how the type of moves are to be identified, and give importance to that of the type of moves rather than that of the levels. I don't think I will have time to give answers to that of the questions. Let me try if FX Street permits. Oh, already. So many. Then, how do you find out the consolidation? When a narrow swings are seen, it is considered as a consolidation for about 10 to 15 pips. Grigor, why do you think USD can reach level? Yeah, it should be able to go above 80 soon. How to get a player's time? I explained that the timings. Don't ask too many questions pertaining to players, which is of no use for you. Okay. An extended move that lasts more than 2 hours? No, extended move only for 2 hours. Afterwards, they consolidate at the higher level or the lower level. If I have a sell at 37.25 and 37.55, see, it shows very clear. Stop at 37.55. The position should place a buy at 37.55 with a stop at no, you are not understood. See, basically 37.25, you have taken a sell and the hedging order was kept at 37.55. When the position makes profit, try to keep stop at entry. When the hedging is filled, 37.55 is filled, then try to watch for about 10 to 30 minutes. If the hedging is not making profit, understand during a small swing, they are hit to a hedging order because they just make such swarming up move in order to attract the buy orders before making further drop. So at that time, your hedging would have been filled. If the hedging is not making profit for 30 minutes, try to close it with a nominal loss or a stop at entry and keep 30 pips above another hedging order. And already they have dropped more than 135 pips. When they have dropped more than 75 pips, reversal, normally they don't do it on the same day. So the sell side, you can book profit. What will happen to the follow your strategy? You can just follow and see in a demo trading platform, and if it is useful, you can use it. False move, intentional move, I explained it. Okay. 2 weeks back, Canon, 2 weeks back in Euro, I made sell position, my hedge filled, but prolonged for 200 pips, 3 times 30 pips hedge filled. Yeah, if we cut, then we will be able to maximize the profit by using a trailing stop. Euro back to 1.40 level? Yes. By third week of November. So don't think that euro will just come down all the way. It will make swings. Is it really to go to 1.31? I'm not thinking about it. Probably it may come to 1.35 or 34 area during downward soften, and the euro is expected to reverse very fast from next week. Obviously we saw BOJ intervention, but are they stupid to act against the trend set by the players? No, nothing like that. See, they need the trigger. They are all timely trigger. You know that when SNB intervened, you know that after everybody's long positions were stopped out and margin call was applied, and they came down to 0.71 and then reversed it in a very big way. That is how the interventions are planned. They are all conspiracies. Don't ask more questions about it. Yeah. I think time is Solomon. Who are they? Okay, let us not talk about them. Can anyone tell core of the session? Okay, what is your website? It is iknowindices.com. If you see my profile, you will be able to get it. Okay, no more questions. Let me go back to that as a PowerPoint presentation. So, I explained to you the market timings. Till 4th, what are the timings to be followed? And after 7th of November, the market timings are given. Yeah, sure, I'll finish it. Then I explained to you the trading strategy, basic trading strategy. When they breach this one, and when they breach the higher the low, what are the type of moves? We have to identify extended move or the intentional move, or a stop hunt or a false move. Then accordingly, track the move based on the time frame and identify what type of trade you can take in. And advantage of hedging, I explained it briefly. I'll probably take time to explain it during the US session. So I have not taken any trade. I'm sorry about it because I have taken more time in explaining all those things. During part 2 of the Tracking the Forex Market Together, after explaining all the concepts, so it is not some hidden secret, I openly explained it. Then following that, during 14 GMT, we'll take the positions and see how exactly we are making profit. Thank you one and all. See you by 14 GMT. Thank you.